Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone today. Today is Monday, December 15th, 2025. And the title of our presentation today is AI stocks have been hammered as value stocks break out. And it's an interesting series of things that are kind of developing as we look at technology. I think some of them are more known than others. We're going to go through a series of stories and patterns that have been developing. And some of the other things that have been happening as money seems to be moving to other parts of the market away from technology. So I'm just showing some disclosures here. And I think one of the big things here is that the S&P 500 overall failed at the October, I believe, 29th reversal day. It was at that high. It was a bearish outside day on October 29th. It was the day when Nvidia hit an all-time high with that $5 trillion market cap. And there is something kind of poetic about that. If you think about if there were to be a spot where the market were to stall, that's an interesting sort of way to think about it. The day that Nvidia hit that $5 trillion market cap, we've not reclaimed that high on the S&P. These are the standardized returns on the ETFs we're going to be talking about. And I'll now jump over to the main things I want to show you. So if you go to tradestation.com, go to Insights at the top here, go to Market Insights, and this will bring you to um, our blog. And on the blog, we have an article here, AI hammers value stocks break out. You can take a look at that. A lot of things we're going to be covering are in this blog post. So I want to point overall, the first thing here is a daily trade, the S&P 500. And what's interesting to me here as we look at this is that this was the high, not the high, but the close. This is the all-time high. This is October 29th, this outside day right here. And look at the close of that day. We basically got above it and we didn't hold. And now we're down below it again. So I look a lot at the 10-day simple moving average for the S&P 500. And what I find is interesting about it is if the market's going higher, you want to stay above it. You don't want to touch it a lot. Usually, if you touch it a lot, it very often signals that the current direction is going to change, and that often is the same in both directions. Although usually on the bottom, what'll happen is it'll plunge way below the 10-day and then spike back up. But at the highs, it'll often just kind of sit and fail to continue. And that seems to be one of the patterns we're getting here. I think it's important to realize now. I've noticed this pattern a lot, and it does stand out to me. So I think what's also interesting here is I'm going to very quickly look at an intraday chart. Look at today's high. Today's high was in the third minute of trading. When you see a high like that early in the session that fails to hold, that is, a potential sign of weakness. So I think that's also kind of noteworthy here. Another thing that's interesting is that we're seeing a lot of heaviness in in Bitcoin and Ethereum, and that has often been viewed as something of a kind of um, indicator for things like the NASDAQ and risk appetite and everything like that. So I think right now we are seeing, some signs of fatigue here. Now we do have some big events coming up, but I did want to just point out here that, we are seeing right now, we look at the S&P 500, this old high, we did not get back above it. And you have this, essentially a zone that is developing here as potential resistance. And from my view here, we might kind of see ourselves trapped. We had previously identified 6852 which was the low on that 29th day, as a potential resistance area. Well, as a level we wanted to get above, and we did get above it, but then we failed to hold it. But from my view here, we might see essentially kind of from essentially where we are here, from kind of 68.90 down to 67.75 as like a long kind of range here. And this might be a zone that we need to resolve out of. And if we resolve to the upside, then that could be a positive signal. But if we resolve to the downside, people might look for a look back down toward this 6,500 area. And so I think right now we have to just realize that there are signs of fatigue developing. Another thing I want to look at here, if we put a trend line on this chart, wait a second, I'm having my trend line. I think I made it a different color. I hit it and make it white so you can see it better. So, but you can basically see if you look at this trend line, we basically, we've gotten below it and kind of potentially turning to the point where it has gone from being support to resistance. Now, I mean, I've seen this pattern with trend lines in different ways, and I'm not, going to make too much of it. But I think the key thing is that you can now look at the fact that the trend line has been broken. It's potentially, turning into resistance. We've seen patterns like this at different times, and this one is one that has a degree of kind of, maybe reliability and significance. But I do think it's interesting to realize that this kind of uptrend here, is kind of stalling. And when you look overall as well here, we're not getting up significantly off that 50-day moving average. As we've discussed before, it is kind of slowing here and showing some signs of intermediate term kind of momentum. Now, I want to show you something else I have down here at the bottom of this chart. This is basically the S&P 500 compared to the XLP, and there's a fast, which is the solid line, and the slow, which is the histogram. So this basically shows us this shows how the S&P is performing against consumer staples. And what I've noticed is that when the market often has pulled back, you'll see that there's the consumer staples. This line goes lower, meaning the S&P is lagging consumer staples. So very often going into a pullback, you'll actually see consumer staples outperforming. That's not always accurate. There are times that it will kind of give you false signals, like across here and things. But the thing is that it does highlight risk off. And I think that's the key thing to realize here. And I think the dominant theme today, as we're going to be discussing, is just the fact overall that we are seeing rotation away from tech, and tech is the leader part of the market, and to see rotation away from that creates a new kind of risk that I think needs to be kind of considered. So let's look at our article here. Down at the bottom we actually have these things called the week ahead, and I want to just kind of point out that tomorrow we have non-farm payrolls, which is out on a Tuesday, but it's because of the government shutdown. So tomorrow we have non-farm payrolls, and we also have retail sales. That's on Tuesday. But then what do we have on Wednesday afternoon? We have Micron. It's kind of the last of the AI related stocks report. And the next morning we have CPI. So from my view here, on Wednesday night and then into Thursday morning, you have two major catalysts between Wednesday's close and Thursday's open. So I want to just kind of point that out. That might be something that if we are going to get a degree of movement and volatility this week, this might be the kind of hinge event. These two events, Wednesday afternoon and Thursday morning, the CPI. Of all the events this week, I would venture to say CPI, the economic data, is most likely to be the most relevant. And the reason why is because I think we know that right now jobs data is not bad enough to justify the government data. The claims are not that high. We have ADP that's been bearish and Challenger gray, but then the government data has not confirmed it. So the thing is that right now, I think that you'd have to see an outrageous drop in non-farm payrolls, I think, to matter. The real issue now is how bad is inflation. I think this idea, we've now cut 3 times, and I think the idea now of cutting further for jobs is not really as likely. The real issue now, I think people are going to be focused on to see what is that CPI report going to be, and I think that's important because this is so. My point in all of this is it Wednesday afternoon, Thursday morning, this is the actual hot spot in the week in terms of potential movement. I want to kind of mention. So as we look overall, I think there's a lot of things that have been developing now that can be viewed as negatives about AI. And one thing is that and we had actually mentioned on Thursday in this article we talk about this place called Chandler, Arizona, voted against a data center project. Then at the same time, this company called Fermi, which is involved in developing electricity for data centers, said they lost a tenant. So, those are two kind of interesting things that have nothing to do with each other, but they all kind of point in the same direction of kind of the data center story, which is obviously linked to AI investment, is showing signs of, there are different kinds of potential issues popping up. This guy named Ruchir Sharma at Rockefeller, he's interesting. He's a strategist there, but he talks about how AI is, he said, overowned, meaning people are heavily concentrated in AI stocks. They're overvalued, and according to him, people are overly overinvested and potential degree of over leverage. It's an interesting point he made on CNBC, but I do think it is interesting as we near the end of a calendar year and we look out toward the future, we are seeing a broader sort of, narrative emerging that is kind of more negative toward AI and tech. There was a note from BCA that actually cited also the risk of depreciation involved with AI things. And I think it's also interesting to look if we see overall here that we're seeing financials breaking out, as we mentioned, healthcare rallying. We're seeing industrials breaking out. So these are now value sectors that are competing with the growth sectors. And very often, what we see at the end, like last week on Thursday, the advanced decline line made an all-time high on the S&P 500. But very often, what we see is we see that breadth improves as as a correction or a period of pullback begins, which is the same thing as there's the same reason why consumer staples do well at the end of an uptrend, which is basically money is still coming into the market, but it's no longer going to leadership areas. It goes everywhere else. And that makes breadth look better. So you get false signals from breadth. And I've been talking about this, that basically the advanced decline line and breadth have served as contrary indicators really for the last several years. And, so again, I think it's interesting to notice last week we talked about advanced decline line hit an all-time high. The new 52-week highs in the S&P 500 were the highest level since March. But both of those pointed back to moments when the market was beginning a pullback. So it's interesting if you look back here on this day, I think it was March 3rd, this was the day when we had the most 52-week highs on the S&P 500 as it was getting sucked lower. So in some ways, this price action here potentially looks similar, kind of is stalling. It's near the 50-day, it's near the 21-day exponential, and it just kind of sits. And if it starts to get pulled down, there's a lot of space where it can get kind of just pulled down and turn into a period of range-bound volatility. And that might be what we see. So I want to just highlight, to me, one of the things I think that is, potential here is that we could get sucked back down into this range. That's really, to me, I think the main kind of technical feature I'd point out is this range and that level that takes us back down toward this kind of 6,500, somewhere in this ballpark. Now, it's also interesting to notice, if you look at this, we have a high, an all-time high on October 29th. But then what do we have in mid-November? We have a lower low than we had in early October. So we have a higher high, but then a lower low. And then what is this? This could be a lower high. So I think that's important to realize also. Look at the S&P on the weekly. We can see a similar sort of thing that we have, the high, the low, the lower low. See, we cleared that, we broke that low, and now there we are. So I want to just kind of point that out. This very tight and kind of, not getting that big continuation to the upside. And so this is something here where there may be some potential, if this does start to break, that there could be a kind of cascading follow through of selling. It's also interesting to look and notice that the big pharma names are doing well. We talked last week about things like Eli Lilly. Look at things like Pfizer. These are rallying today. And what is interesting is the biotechs are not doing as well. The biotechs are just kind of stalling. And this also shows me a degree of risk off. The small biotechs are more risky. And then the big pharma names like, Merck and, Pfizer and Eli Lilly, these are your kind of more safety plays, the big safer names. So again, this is also kind of consistent with a pattern of risk off. And Also, it's interesting today. There's a strategist at Bank of America named Savita Subramanian, and she said the S&P next year, she set a target of 7,100. So we mentioned some other things in here about different forecasts on the S&P 500 in our article. We talk about Wells Fargo is saying up to 7,600. Oppenheimer sees maybe 8,100 in the S&P, and now here we are. We have Bank of America coming out and saying 7,100, and she's saying that we could see multiple compression. So interesting just to kind of think about. But one thing I will say about multiple compression is that if people start to doubt the lasting, the ability of growth to keep lasting and continuing, that would be consistent with multiple compression. So I think that's overall also something here just to think about. And another unusual note, I think he was on Bloomberg, but David Sachs, who is involved in the Trump administration. I'm not sure of his exact title, but he's known as a tech investor, an AI investor, a crypto investor, David Sachs. On Bloomberg, I believe it was, in the last few days, he said that Nvidia, that China does not want to buy these Nvidia chips. Now, I mean, who knows exactly, but someone like David Sachs to make a statement like that is something I think to kind of think about. And so the thing is, people have been kind of looking for Nvidia to monetize these the H20s, I think, or the H200s, whatever they're called, these chips that were designed for China. Well, guess what? I mean, now there's people saying that's not going to happen. So I think it's just important to realize here that if you take a step back and look at some of the things mentioned in this article and some of the things I've also mentioned here, there are a lot of things here that maybe now are, potentially more, more warning signs popping up around the whole kind of world of tech. Now, I think the other thing to me that does stand out, we actually have here a trading view idea. Is it basically we did a trading view idea on the 10-year treasury yield, and to me now this actually is emerging as a potential risk as well. Now, this is, I think, upside risk in the 10-year could be a problem if it does have a degree of follow through. Now, I have to realize that the Federal Reserve last week, it was a very strange meeting, but they raised the GDP estimate for next year by 50 basis points. Now, that would be consistent potentially with higher treasury yields. So if we have, higher treasury yields and inflation staying over 2%, I mean, if we have faster economic growth and inflation staying over 2%, and more deficits and everything like that, there could be some risk here of this, moving to the upside. So to me now, the main risk, or what I don't want to say the main risk, but a potential risk that could be popping up now is that we could see a squeeze higher in treasury yields. And if that happens, what we've been seeing in financials, what we've been seeing in small caps could be out the window. And we could end up in a spot where yields moving higher. Like if you look back to 2023, there was this period of time when the yields kind of squeezed off their lows and they moved higher. Well, we've basically had a period now, really it's hard to believe, for over 2 years. I mean, I can't even believe how long it's been, just this period of complete sideways movement. And if yields start to escape from this range and run to the upside, that could be a risk. And the other thing is, we are seeing it with things like Japan and stuff. So I know I don't want to get too kind of in the weeds about global bond markets. But the thing I need to realize here is that this is something that could turn into an overall negative catalyst for risk. And this is something I think to watch, because if we do start to really get much above 2.25 on the 10-year, it could start to ring some alarm bells. And you look at how tight it's been, it could turn into something that actually does extend. And this is something I think that's out here is now a potential, real kind of thing to be aware of. Now, the other thing that's interesting is that the utilities ETF, which are interest rate sensitive, really has pulled back a lot as well based on yields, moving higher. So I think we also have to kind of, bear that in mind. And also, apparently, I only discovered this now, but back on December 2nd, BlackRock put out a bearish note on treasuries. They basically said the long end of the yield curve, the 10 and the 30-year treasuries, could see selling pressure because companies like Oracle and other AI companies are going to issue so much debt to build data centers. And we could actually see, investment grade, high quality investment grade companies like big tech stocks competing with the US Treasury to raise long-term debt. Interesting point. I mean, BlackRock, I think, is the biggest. I mean, they're one of the top two or three fixed income managers, in the world. So for them to say something like that, that's an interesting statement. That was back on December 2nd, if you want to look for it. So I want to just kind of point those things out. Now, there are some other things I think that are interesting. Last week, we were talking about Tesla. Now, today, Wedbush came out with a positive note, and here we have Tesla actually. I think they might have hit no, it didn't reach an all-time high, but it's like back to these levels from from a year ago. But I want to just kind of point out that Dan Ives from Wedbush put out a very bullish note today on Tesla. Says saying it could go to $2 trillion, and there is an increasing focus here on the robo taxis, the actual robot product that we could see next year. I want to just kind of point that out. And now another thing that's also interesting is that Alphabet actually has a Google or an Elon Musk connection, because there have been reports that they have apparently a stake in SpaceX. I don't have the number in front of me. You can Google and see. There's basically been this report that that their large stake in SpaceX could actually result in something positive for their stock overall, and it could be a big valuation. So I think this is something also. What's interesting, the reason I point this out is if you look at the mega caps here, we've seen Google emerge as the kind of new, one of the new leaders, as Nvidia and Microsoft and Amazon kind of go nowhere. Well, then guess what? We've seen Alphabet emerge as a kind of, an alternate mega cap that has been outperforming. But Tesla could be also in that club. So I think we really just need to realize here is that there's been these positive catalysts on Tesla. The actual nature of Tesla is evolving from a pure play EV into AI and robotics and everything else. And people might actually hone in now on Tesla as the play for robotics and basically what Jensen Wong has called the physical side of AI. That this might be the stock people focus on. And I think it's a really important point to make. And apparently, I think Dan Ives was actually speaking on CNBC today. I don't want to overemphasize one analyst, but he is influential in the space. He made this call, got a lot of attention. And so I want to basically point out here that Tesla and Alphabet seem to have a new thing coming together. And I did mention when I seen about things like Eli Lilly, we did a trading view idea on it last week. I think Pfizer coming off these lows is actually something people might also kind of pay attention to. And then things like Merck. So all of these here are areas that we've talked about as basically noticing that, again, this is the opposite of tech. In many ways, when people are looking, the safety plays, all that sort of thing, healthcare is showing some patterns here which are potentially interesting in terms of healthcare, but they also are potentially warning signs for the other risk on parts of the market. So now I'm going to jump into the indexes as we always do on this webinar on Mondays and kind of look at the overall charts on the weekly mostly. And I think here the main thing is really that we have, I mean, I actually put a line at 6,800. We had another one down kind of 67.75 area. But from my view here, it's interesting to see how 6,800 been kind of developing and as a kind of support area. And so I want to just point that out. If we get much below that, the problem with a range like this is you can draw your levels in a lot of places, but once you don't have a clear, I mean, we have a clear high here at the top, and then any of these levels can come into play. I mean, a level like back here from November 7th around 66.34 could just suddenly turn into a level to watch. I mean, there's a lot of places. The key thing is that we're inside of the range, and very often when you get inside of a range, you get sucked back into that range. And I think that's the main thing I want to point out here at the S&P. There's a lot of places we can draw lines, but the key thing is that we are between the lines, we're not above the lines. And I think that's kind of the main point here for a lot of this. Okay. Also here, let me jump to the Qs. Interesting about the Qs is last week we had a bearish outside week. Look at this. See, that's a bearish outside week. It's a failure. It's a reversal. Look, and we've talked about this pattern. See, we did not close at an all-time high at a weekly. We did not make that closing high. And so to me, this is actually something here where it's very similar to the S&P. But from my view here, this is one that people might look and they might see down here something when you get sucked back to the downside. I mean, you could be looking back to the level here from like kind of late September, early October. This was the day when I think Trump renewed his trade war with China for, you got those headlines. So we have a level here. It's equivalent to around 6,500 on the S&P 500, down around 588. And at this point, I think you guys just realize that this is just a range that this, could turn into, but is essentially a range. And in that environment, I think you got to realize that a lot of these intermediate levels inside of the range might not be hugely important, and we might just simply look to have that range express itself and embrace it. Now the Dow here, I mean, it's a similar sort of thing, and I would say that overall at this point the Dow kind of did its thing, it extended, and I think you got to just realize now that what we've seen in terms of this value pump, we have to just kind of realize that looking for it to continue if the broader overall market gets heavy, that might not be really what people are looking for here. So from my view, I think we have to be careful of trying to distinguish anything and looking for too much to diverge from the overall S&P, which is essentially the NASDAQ here. So from my view here, this is something where it kind of had that confirmation and that pump, and now it's kind of drifting. And if people are looking for any opportunities in this, I mean, the issue with something like this is if the market does pull back and get kind of bearish, then what will happen with something like this is it could lead and do better for a little while, and then you end up with basically then the sellers just come and get it too. They'll come and target it too. So you might see, if we say, for example, we do have a period of weakness here, this might hold up for a little while and you think, oh, that's great. And then before you know it, one day the sellers just show up and slam it. The other problem is that if we have weakness to the downside and then this thing outperforms during the period of weakness, then when the market wants to rebound, this won't necessarily perform. So I think we have to realize now the Dow is kind of this weird index, and it's in a spot where it may not give much opportunity on anything. And I think the Russell's kind of in a similar spot as well. I mean, it did have certain things that were positive appearing, but we have to realize that if yields move higher, this is an area that very well may struggle. So I think also to be careful of kind of overcharting the Russell and making too much of its own patterns. In many ways, it's just the kind of derivative of other things. It's a derivative of risk appetite and of yields. And if those things move, if yields move higher and risk appetite moves lower, it might be difficult to see the Russell really break out and make new highs if the Nasdaq is struggling and the overall market has increasing volatility. So as you now turn to the 10-year, I mean, I mentioned this, and from my view, this is now getting in a spot that has some problems here, potentially to the upside. We can see we have a series of, a rounded bottom here. If you look back in mid-September, then October 20th, and then here you have basically a low, a lower low, and a higher low. This is kind of a basing pattern here, and from my view, this is now kind of turning into more of a potentially problematic move. So I think we need to kind of watch this and realize that if we get much above 420 or four and a quarter, up into this range, up into like the 430s, this is going to start to potentially ring some alarm bells. So I think this is one we got to continue to watch. And some of these patterns do suggest that after this period of sideways movement, there could be some upside risk. Now, I think I also want to just mention, I'm seeing more and more evidence of weakness in the housing market and the deflationary effects that will have. Oil is struggling as well. China is struggling. So there are things here that are not necessarily compatible with higher yields. So it's a very mixed bag, and I don't want to overemphasize any part of it. I think we have to realize is that there are some technical warning signs on the 10-year. Now that materials here are just stuck in a range. I think people might want to look at, they're going to look for much movement in materials, the XLB, just to see if you're going to break out above kind of 46.19. Otherwise, this is kind of at this point just range bound with all kinds of really no clear edge or any kind of clear patterns on this chart to tell us much of anything. Now the XLC communications, these are also in a spot where these are very well may follow the broader market. And I think right now there is a little bit of risk of some of resistance forming around this level where they kind of peaked back here. And I think also this is an area where this has been a strong overall weekly chart, but this is also an area here where I think technically there's not much edge on anything. There is a positive of what we've seen in Alphabet, but we've had a lot of weird stuff with M&A in the traditional media space with all the stuff on Warner Brothers and Netflix, and then we also have a lot of things with you know Meta. They might announce that they're gonna cut more costs or something like that. So from my view here, technically there's not a lot really on the XLC at this moment because there's a lot of potentially meaningful signals. Now the XLE, we've talked about how the fact that this does, despite giving a college a try to have some upside here. I mean, it still remains in a pattern here that is potentially lower highs on the weekly. Oil continues to really struggle, and I think right here this is in a spot where people may look for this to push back down toward kind of 42.10 or kind of 42, this area from back here. Now this did have a stock split, so some of the levels we talked about before have all gotten cut in half because it was a 2-for-1 stock split. That was XLE. XLF getting something of a breakout here, but it's the beginning of the week. And if you look at this on the daily chart, I mean, it's kind of also, I mean, this could be something where people look for it to kind of hold in this range and then see if we get some kind of follow through next week after some of the events this week. I think right here, if you look at it on the daily, I think we're going to just kind of wait and see how much this candle does it hold. Does it kind of just sit here and consolidate? So I think right here, XLF is giving some potentially positive signals. We had talked about, XLF and XLI potentially breaking out of these ranges, and they've done that. But now I think we also have to be careful of this idea of essentially, if the broader market has trouble and the big tech names have trouble, it's not clear like how well something like XLF will hold up, especially if you see upside in treasuries. Now, XLI here is in, like I said, is in a similar spot. So we had that close last, a record weekly close last week. And I think for both of these, XLI and XLF, they're very similar. You might want to just kind of wait and see, where do we go? Where are we on Wednesday and Thursday? Do we get, some more kind of testing down into these levels? And I think right now, for the near term, people are very much going to just kind of, watch for these to kind of sit and then to see where we are later in the week. Um, these do have the potential, though, to be leaders in the new year if there's not a lot of upside risk in yields and things don't get too, if we don't see, too much overall weakness in the new year, this might be something that XLI and XLF could very well be the leaders in 2026 based on the patterns we're seeing here. Now, XLK here also just getting sucked into this range. And I think that's, again, the same thing we're seeing with like the Qs. The technology here is very much in this kind of range. And people may simply look, I mean, it's a lower high here. And I think that's also something that is potential risk. Actually, I want to mention on the daily chart of the Qs here, which is basically that people might look for something like this to happen. So I want to just point out this is a risk here that we see basically a channel like this taking shape and some kind of attempt to go back into these down to this level. There's a problem when you start making a lower high and things like that. All these potentials come into play. And so I think also with like the idea, I would just say with Micron earnings and stuff, they sold Oracle, they sold Broadcom. Micron here is kind of like this, a potential also similar thing. Look at the SMH also. Oh, no, the stocks. Look at the stocks. Look at the stocks here. Essentially, you can see we had a false breakout on the semiconductor index on a weekly chart. This might also be something here. I'm sorry, SOX weekly. You can also see this might be something of a double top here. A lot of these thick candles. This, I think, is a very important chart that, overall semiconductors have been really leading tech. And I think right here we have to realize that this is now potentially setting up to be something of a double top on the SOX, and Micron fits into all of that. So I want to kind of point that out. Broadcom got hit hard after earnings, and Micron might be in a similar sort of position simply because it's priced in a lot of good news. This is the way some of these stocks trade. Stocks like Micron, they're kind of crazy. They move in a straight line, but then when they stop going straight up, they can go, if you look at the history of this stock, it can go straight up and then straight back down. And the other thing about this is that very often Micron is the last chip stock to rally if you look at historic chip cycles. That is, I was talking about XLK. Very quickly, XLP, I'm running out of time, but I was mentioning XLP here. From my view, it's just in the middle of this range. It's not telling us much, but if it continues to press higher here or kind of hold its ground, this could be something also that gives us some warnings on the S&P. If the S&P wants to rally, though, this could get stuck right back down to the bottom of its range because this usually moves in the opposite direction. Now, real estate here, I think people might want to kind of realize this is that there's a lot of debt refinancing that has to be done in the next year or two on commercial real estate. These guys are making a lower high, and people looking to really who might see some potential for like some downside. This is something that might be setting up for some bearishness in the new year. I mean, 2026 could be a year that we see more pain in commercial real estate. XLRE here. I mean, this chart is really not giving a lot of bullish signals. It's been holding this level around 40, and there's these lower highs here. So people might look for the XLRE to actually have some more downside in the new year. Now, XLU, we talk about how utilities get sucked down to these range based on yields. And I think right here now we're in a spot where utilities are also kind of very sloppy, getting sucked back down into this range. There's uncertainty about yields, there's uncertainty about data centers and things like that. Another thing I want to just mention, we mentioned last week on market trends. We said that, and I didn't even know about that thing coming in Chandler, but Arizona, we basically said next year's an election year. AI and data centers are getting unpopular. There could be political risk of people looking to, regulate their use of electricity and a lot of other things. Well, utilities could find themselves in a kind of center of that focus if there is some pushback on data centers and AI. That could be the way that people express it. So I think we have to realize here is that these are in a spot where there's a lot of things that could start to become more problematic. So I think here utilities are also in a spot where people may look for things to be at levels like at the bottom of a range where they may have more clarity. And at this point, that might not be happening. So XLV here, the healthcare, this is one where we had talked about how, it kind of stalled this level, but it came down and held that high from February. So from my view here, I mean, this is one that people might actually start to see as kind of, a kind of clear sort of area for people to look. It's an area that is essentially kind of risk off. It's non-cyclical, a lot of things like that. Healthcare here, I think of all the charts I'm looking at now in terms of the overall price action, for the current, kind of period of time, healthcare seems to be the one that's putting together the most sort of strength overall. And consumer discretionaries, XLY, I mean, these are potentially trying to have a breakout now, and this is linked to Tesla. So I think the thing is, hey, if the Fed is right and GDP does accelerate by 50 basis points next year, and Tesla has good news, whatever they do with their robots and all that stuff, XLY actually is in a spot where, despite the other sort of things happening, it is growth, but it's not tech. And it might be an area that actually growth investors might focus on. They might actually notice, like I said before, Tesla and Alphabet. Those might be the two mega caps now where we really start to see the attention. And then I'll mention the other emerging mega cap. The other emerging trillion-dollar company is Eli Lilly. It's around 920 billion now. It hit a trillion market cap up here, but people looking for the quote unquote mega cap trade and all of that, Eli Lilly now is really starting to emerge again. And I think that this is a name that in the new year, people could be more focused on. So those are the main things I want to talk about today. We'll be back to do market trends on Thursday. I hope everyone has a great day. Don't forget about what we said about the upcoming events, which is basically that we're going to see um, on tomorrow morning, we get the payrolls and the retail sales. Then on Wednesday afternoon, we have Micron. And then on Thursday morning, we have CPI. And then Thursday afternoon, we have market trends. So see you then.